Good morning, good afternoon. Welcome to today's GIC College of Central Bankers webinar. I'm Kathleen Stephenson, the Vice Chair of the College, and today we will be discussing the implication of credit crunch in advanced economies on emerging market economies. As you well know, the combination of rising interest rates in advanced economies and already high debt levels in emerging market economies continues to put strains on government balance sheets. According to the Institute of International Finance, emerging market debt levels, so that's the government as well as the private sector, rose in the first quarter of this year to more than $100 trillion, and that's up from $75 trillion back in 2019. So tighter financial conditions and rising borrowing costs in advanced economies imply limited emerging market borrowers' access to international debt markets, as well as a potential rise in defaults and negative spillover into the real economies. So to help us sort out these dynamics, we turned to two distinguished fellows of the GIC College of Central Bankers, Jose de Gregorio and Mustapha Nabli. Jose is currently the Dean of the School of Economics and Business at the Universidad de Chile and a fellow of the Peterson Institute for International Economics. He is also the former governor of the Central Bank of Chile and former Minister of the Economy, Mining and Energy. Mustapha is professor of economics at the Tunis University and a former governor of the Central Bank of Tunisia. He was also a former Minister of Economic Development and senior advisor to the World Bank chief economist, and he's also the author of multiple publications. We will first start with Mustapha and then hear from Jose before we open it up to the audience for questions. With regard to the audience, I would urge you to type the question into the Zoom designated area, as you well know, I'm sure, from now on. And the floor is yours, Mustapha. Thank you.
Thanks, Kathleen, and a pleasure to be with you today. As you said, I think we should start by putting this in context. And as we all remember, the last 3 years have been a context of major shocks for emerging markets. Let's recall that there have been at least 5 major shocks, external shocks to emerging markets in the last 3 years. First, the pandemic, the COVID-19 pandemic, 2020-21. Then we have the ongoing, it has started already before that, but continues and strengthened, the tensions between the US and China, which has been disrupting international trade. Then we have the global inflation in 2021, the surge in inflation together with the beginning of the recovery from COVID-19. Then the fourth shock was the US anti-inflationary policies, which started early in 2022. And finally, we have at least the fifth shock was the Ukraine-Russia war. Of course, these are many shocks in such a short time, and they are meant to have some significant impacts on emerging markets, and they did. Now, it is very difficult to try to figure out exactly how the credit crunch itself, which is one of the impacts of the U.S. monetary policy tightening in 2021-22, it's very difficult to figure out what's the impact of the credit crunch itself as compared to the impact of the Russian war or and the Ukraine war, or of the U.S. tightening of the U.S. policy itself, or whether it's the own response of emerging markets to the surge in inflation in 21 and the impact of the pandemic. So it's very difficult to figure out, but let's try to see what we can say as of this time. Of course, the tightening of the U.S. monetary policy and the credit crunch, which followed the in 2023, the impact on a number of banks and the closure of banks and so on in the US and later on in Europe, had an impact on emerging markets. And broadly speaking, I think we can say that emerging market, there has been a slowdown in growth overall. There have been high inflation, even though it has been moderating recently. High interest rates throughout within emerging markets as well as on global markets, whether it's domestic interest rates or spreads on debt, and overall tightening of financial conditions in this context. Now, what can we say about the impact of the credit crunch itself? It seems from what we have learned over the last few months, if you like, that one can really draw three major, lessons or observations, if you like. Overall, and unlike in previous episodes, the overall impact on the emerging markets has been quite muted overall, we can say. Second, overall also, emerging markets which had strong fundamentals and had even sometimes stronger fundamentals than advanced economies have been more agile in managing the impact of the monetary policies that have been pursued following the surge in inflation. And the third major observation is that to the extent there have been any significant impacts which have materialized in emerging markets, they have tended to differentiate significantly between two broad classes of countries in emerging markets. The first group of countries are what I would call the high quality, the strong emerging markets, and then the other one, what the IMF would call frontier markets or smaller and riskier markets, emerging markets. And so I think it's important to distinguish between those two, because if we lump them all, we cannot really get a good picture of what's going on. So let me try to say a few comments on each one of these groups of countries to try to kind of illustrate what I am trying to convey. The first group of countries, what I call high quality and strong emerging markets. These countries tend to have stronger fundamentals. Their banks are better capitalized. Their fiscal situations are stronger. Interest rate risk is smaller. They have limited short-term debt overall. And clearly, these emerging markets, many of them have started actually their anti-inflation well before the US. Since 2021, they have started tightening their monetary policies and trying to contain the inflationary impact of the surge of the inflation in 2021. This meant that for these countries, while the overall impact has been limited, there has been some increase in financial conditions constraints. There has been tightening. This has depended clearly on regions and countries. Clearly, Latin America probably, and other countries are more than East Asia. But overall, there has been some impact, but not really very significant. There has been limited impact on debt issuance. There has been some capital outflows, but these remains at manageable levels, if you like. And the capital outflows have been substituted by private inflows from banks and non-bank financial institutions, if you like. Equity prices have been impacted in most of these countries, but to a very limited extent, and most of the major banks have not been impacted really in a significant way. So that's what we can say, if you like, on the high quality and strong emerging markets. However, most of the negative impact is really on the impact on frontier, smaller and riskier emerging markets. While this class is not well defined, one can use some characteristics of these countries. Many of these countries have weak fundamentals, weak fiscal positions, high debt levels, already starting from well before the pandemic, but has been increased and strengthened during the pandemics in terms of fiscal situation and the increase in debt and so on. They saw their the spreads on their debt has been very high. The IMF estimates at almost 900 basis points on average. They have low reserves, and they have also limited fiscal space overall. Now, the impact of these countries, while it is not really all due to the tightening of the monetary policies and the credit crunch, but one can say that the credit crunch and the tightening of financial conditions had a significant, stronger impact on this country than the rest, which has, shown up mostly on the on debt and debt distress. I think some estimates show that at least 18 countries are in debt distress. They have spreads which are higher than 1,000 basis points compared to the US Treasuries. And many of them, at least 7 or 8 of them, are already in default. And a few of them are likely to be in default, have a probability of being in default that is really quite significant. Now, these countries are really in trouble. And the options for them are really two. Either to follow IMF programs, and most of them are either in programs or trying to get, and they have to have some debt restructuring. And most of them, they have to get into both of them. They have to have the IMF program and the debt restructuring. But the debt restructuring has not been going very well. And the framework for debt restructuring has been, not very successful at this point in time. And we expect that the situation will continue to worsen as we speak. Let me stop at this point and we'll continue the discussion later. Thank you.
Thank you very much. And I think that now we should move on to Jose. If you could please tell us what your thoughts are on this subject. Thank you.
Thank you very much, Kathleen. It's a pleasure to be here and sharing with you and Mustapha this talk. First of all, I have to clarify, I will talk assuming there will be a credit crunch, because it may not be a credit crunch. However, a credit crunch is a risk. And if it happens, it could be very costly. And we need to think, if it happens, what are the consequences, what countries have to do, and how they have to be well prepared. So we not only need to be prepared for certain events, but also for events that are likely, perhaps not highly likely, but it's important, in particular because the costs are too high, are very high, the cost of severe term. That's the first remark that I would like to start. And the second, which I think that is, before going more in details, the second, which I think that's quite important, I will take a provocative view in this, and just to make the point, emerging markets have gone through much financial tension in the last 20 years. They went through the global financial crisis, pandemic, a lot of turmoil, the taper tantrum in the mid-2010s, in 2013, so on and so forth. We can mention a lot of them. And they have been able to cope quite well in all these events. Overall, I would say there has not been an emerging market crisis, like the Asian crisis, like the Latin American debt crisis, or so. So I think that and indeed, there is much more to blame to advanced economies than to emerging markets. The global financial crisis was a problem in the global economy caused by excesses in financial system in advanced economies. The Greece turmoil, and the big was a problem within the building and the strength of the European Union, so there was some. So emerging markets have been able to cope with this without with some cost, but nothing too dramatic, which shows that there are things that have gone relatively well. And Mustapha mentioned some in good countries. I would make what are these things? First, they have consolidated low inflation. There's low inflation today. They have granted many countries independence to central banks. Currencies fluctuate. There is much more flexibility in currencies among emerging markets. And financial systems are quite strong, what the evidence have shown, due to previous dramatic financial crisis. So this is not so basically we had our quote unquote big crisis financial much before the global financial crisis of 2008, 2009. In Latin America was in the 1980s, and many countries, so they have built resilient financial systems. There are many products in the emerging market. And I want also to make, so I think that this is also important to bear in mind. We tend as economists to say, well, there is problem, we need things, we need the instrument, but the current framework in many emerging markets is quite strong and resilient. But I have to be very clear and depend a point that Mustapha made. Not all emerging market economies are the same. And I think that it's a good thing that what he said is there are some that are kind of strong and others that have more vulnerabilities. Perhaps this could be more in the universe of what's called the frontier economies rather than the consolidated emerging markets. Okay? So this is true. In the case of Latin America, for example, when you talk about, and I talk many times about what's going on in Latin America, things are going relatively well, but one always has to exclude Argentina and Venezuela. Well, there are special cases, very bad cases. Of course, they are not within the main trends of the rest of the country. So that's what I think that is important to clarify, that not all are the same. But if we take the world of emerging market, I would say it has not been the responsible or the cause for recent crisis. And compared to previous decades, it has been much more resilient, the universe of emerging market. So now the issue, what is this credit crunch and what are the implications for emerging market economies? I think that what is really a credit crunch, Caitlin put it very well, is a tightening of global financial conditions. It's a reduction of the supply of credit. So we're used from time to time to tides of capital flows to emerging markets. This is what has been called the pull factor of emerging markets. Sorry, the push factor. This capital moves from advanced economies or from countries with a lot of funds searching for yield, searching for new opportunities. So there is a sort of autonomous movement towards countries of capital flows. of course, with tightened financial conditions, this won't happen. And also, the consequence is a rise in interest rate. It's a rise in interest rate in a world in which we have been used to low rates since 15 years at least, I would say, and with a persistent decline in global interest rates since the 1990s, we are in a world that has been used to very low interest rates. So what could happen in credit crunch in advanced economies? It should be, in the short term, a lot of turmoil, exchange rate depreciations, tensions in financial markets, but the more longer term consequence, and this is, I think that is a quite important issue, is that we may end up in a world with much higher interest rate. This is a probability. I'm not completely sure. I have been tend in general to think that the fundamentals should lead to a decline in interest rate, but there are reasons also to think that perhaps we may end up with rates in the world in the order of 100, 200, 300 basis points higher. And if you increase in the long term the rate at which countries borrow and which governments borrow 200 basis points or 300 basis points, that's a lot. That's a lot. And what in any scenario could be to have a sustainable path of fiscal policy, you may end up having an unsustainable one. So I think that the main concern, we are in a world in which there are high levels of government debt and corporate sector debt. And the government debt, the high debt was exacerbated during the pandemic because of the strong and reasonable policy of fiscal support. But the consequence of that was that you end up with very high levels of public debt. The high levels of public debt that at a very low rate, as I said, could be fully sustainable, but in a world with more frictions in credit markets, with higher rates, it could create some problem for government, and this is a risk. And I think that we have to take it seriously. In my view, it's the most complicated or the most serious risk that we face from the potential credit crunch. On the other side, there are the corporations. Corporations have gone through very high levels of indebtedness during the last couple of decades. I say since the end of the global financial crisis, there have been a lot of liquidity in the world. Now, in general, that is a much more, I would say, when you tap financial market, you do it with a project, the firms take care. I don't think that there could be still the levels of leverage and not something that you say that there are some threats on the corporate sector. I think that the main problem may come from governments, and the government that may need to have a very strong adjustment, some borrowers that could enter default. And of course, as those effects are more widespread, the risk on the global financial system or the risk on the financial system that's more linked to emerging markets could be problematic and can exacerbate the financial cost of a credit crunch. I would stop here to keep the conversation.
Thank you so very much. And I wanted to, before we continue the conversation, just want to ask the audience to just type in the questions, and I will look at them and pose them. But before we do that, I'd like to take advantage of my position as moderator to ask you a couple of questions. So starting with you, Jose, you say that at the moment the credit crunch is a risk, and it's a real risk, if you will. Do you get a sense that countries, emerging market countries, are taking precautionary action against this potential risk?
That's an interesting question. It's an interesting policy question. Because, for example, in the case, I haven't seen broad-based decisions. Now, you don't know exactly all the details. In the case of Chile, there was some prudential measures on the financial system. Now, the question, the question is, do we need something additional, precautionary, for emerging markets facing a credit crunch, for countries that weather the global financial crisis and the pandemic crisis? As a general statement, I would say don't think so. So if you were able to survive in the global financial crisis, it was the first big crisis after the Great Depression, and the biggest, and we thought that we were dying, and that was the end of the world because we were not used to that. And after 3 months in many emerging markets went very well. Then it came the pandemic, in which was a huge debt crisis, because the pandemic was a crisis in which firms do not have revenues because they have to close to pay the banks. Banks do not receive income, so it's a big mess. Now, with a lot of support of government and central banks, we were able. So the question comes, so do these countries that weather well the crisis, need to do it? I would say overall, if they were able to survive the pandemic and the global financial crisis, a credit crunch is a hiccup. So however, there are countries, and Mustapha was very clear, and I think that there are countries in which their financial system have deteriorated and public finance have deteriorated. So the question is, you don't need to say, well, I'm a country that did well, but there are countries in which, in particular, public finance. So in those countries, I think you have to be prepared for a world in which it will be much more difficult to find financing for the government.
Yeah, and Mustapha, in that respect, I mean, you were talking about these frontier markets, and it's when you list the 5 shocks, and this is, of course, after the shocks that we had with the GFC, these frontier markets, when you think about it, shock or no shock, it's the idea here is for them to really address fundamental, action, if you will, or the IMF programs, as you say. So it's almost irrelevant of whether we have a shock, a credit crunch, or anything. The situation is dire.
Obviously, when you take any one of these countries and you see, it has had fiscal problems going on for, well before the pandemic. And the fact that they have problems is that they are countries who are unable to manage well their economies, right? Because if they are resilient and well managed, they wouldn't get in trouble to start with, okay? So the fact that they get in trouble, and they were already before the pandemic, they had fiscal issues. The pandemic, makes them worse, and they still don't have the ability to manage well. So they just keep piling up debt, okay? So they keep piling up debt, and then you have the Ukrainian war, and then they have the balance of payments deteriorates. The oil price goes up, and the food prices go up, and therefore the balance of payment, goes, off track. And they keep piling up debt, and they're stuck because their politics is stuck. Because why to start with, they are in trouble. They are in trouble because their politics is stuck somewhere, and they are not able to manage well their economies. And so they are vulnerable, but they are even more. But when the interest rates go up, and when access to the financial markets dries up, and that's what we have seen. Since the tightening of the monetary policy in the US, practically all of these countries have been pushed out of the financial markets practically completely. And the spreads have spiked, up to, not 1,000, in some countries, 2,000, 3,000 basis points and so on. And so some of them are really off the charts. So yes, you are right in a way, because saying that credit crunch or tightening of monetary policy, they are in trouble, yes. But let's not forget that this makes situation even worse and more urgent for many of them. And that's why we have seen in 2022, a bunch of countries default. And it's not excluded that with the next few months, we'll see some more to default.
Right. And, it's interesting because when you look at over the past, 15 years or so, the ability to get through the global financial crisis, at some level, one can argue that the massive reflationary policies of China has helped, particularly for commodity export kinds of countries. One would hope, and I think that, the ones that you mentioned, Mustapha, stronger fundamentals, and the same thing for you, Jose, the stronger fundamental EM. I mean, they have managed also to conduct some fundamental changes in their economy and financial system. But one question, though, is that in previous emerging market crises, the borrowings in dollars expose these markets to volatility in the foreign exchange rate. Is that the same this time around?
I have been working on this. I have a recent research on this, and I have a paper. I just finished writing a draft some weeks ago.
Do share.
Yeah, it's interesting. I will put it on I can put it on the chat of the. It is interesting because we were used to say, and it is true, what's happened is that countries used to borrow in dollars, and they used to obtain their and borrow in dollars, have their asset in pesos. So if there is a depreciation, you have a wealth decline, a wealth transfer to the rest of the world. Mm-hmm. Because your liabilities go high and your asset the same. The US always has been said this exorbitant privilege that the US is shorting its currency. Why? Because there is a lot of foreigners that wants US bonds. So when there is a depreciation of the dollar, there are much more foreigners that lose money. And the US receive a transfer from the rest of it. Now, what I have seen in the case of Chile is quite interesting. I will just, because it's fascinating, it's how I got very interested in looking more carefully at this data. In Chile, in 2019, we have a huge social uprising. The social uprising brought a 15%, roughly, a 15% depreciation of the currency, 20% decline in stock market. We were a country that in the net owed to the world 20% of GDP, and after 2 years after, we owe to the world 5% of GDP. So in this pretty bad environment, we receive a transfer from the rest of the world. Why? Because foreigners take position in pesos, and our pension funds, everybody invest in dollars. So when there is a depreciation, we gain. So we gain in, contrary to what's happened in the past. In the past, in the debt crisis, governments and corporations borrow a lot in dollars, and they have their money in pesos. There was a depreciation, they went bankruptcy. Now, this is not only the case of Chile. We find evidence for 20 emerging markets that happens to be the case. So in a way, let me put it this way, which is kind of these are all countries that have gone through process of financial liberalization, that have more integrated to the rest of the world. So as you integrate to the rest of the world start demanding your currency. And so this is shown to be an effect that happens in the last 10 years, which was when the maximum openness financially in emerging markets you observe. So I think that this traditional view, I don't want, because I wrote a paper, I said that this is the new, whatever, but this traditional view that the depreciation was okay for export, but was bad from the financial perspective is no longer right, I think. I think that from a financial perspective, it's also good.
So,
but this just one comment on Jose. Yes, this is right, but at the same time, this same phenomena is likely to increase the likelihood of the speedy and very quick outflows as soon as the pressure on exchange rates will start showing, right?
Yeah, but
and therefore,
but the outflows come with a weakening of your currency. So
but they'll try to beat it. So they will try as soon as the likelihood or the signals on the depreciation start showing up.
They run out.
They will run out as quickly as possible, and therefore the likelihood of the crisis of the balance of the exchange rate crisis is going to be increasing probably.
You have a very good point.
It has this other impact. Yeah.
Which my simple solution, and this is, I think, important, is when countries let the currency float, the exchange rate adjustment happens faster than you take your money out. So what that phenomenon is typical phenomenon of countries that try to defend the currency. So in the time that you are trying to defend the currency, you say, I better go out now because tomorrow will be much cheaper this currency. So I think that the compensation comes a little bit from within limits.
So you mentioned that you see this evidence in many emerging markets. So not just in Latin America, you've looked at.
No. We have a list of 20 emerging markets, and this happens for the average. So I don't know exactly. I know the details well. Right. But at the end, what has happened is that in the world, I would say, old world of banking financing, of course, it was much more vulnerable. Mm-hmm. But today, we have a world of much more portfolio finance, foreign investment. When an investor comes to your country to invest in Chile, they invest in pesos. They cannot, but Citibank gives one, when lends in dollars. But the foreigner that comes and they build a road or whatever, they demand pesos. And that's, I think, is what's making. So this is the old idea that there are different kind of flows with different vulnerabilities. That's right. That happens.
Right. So in essence, again, there is this major distinctions that we have to make between portfolio flows and, more like the traditional FDI flows, right? So that stays in pesos for investment in tangible types of investment in the country. But the question, though, is there is a vulnerability from the political side. And we're talking, potentially more of a quote unquote nationalistic or left-leaning type of policies. Would that impact your findings?
I'm not so sure. Because I think that the most important thing that you want to really know is how long or short are countries in their own currency vis-a-vis the dollar. And as countries have been opening up during the first decade of the 2000s, there was, of course, much more foreign investment and flows. But even what's going on now, that even for debt, for capital market debt, there is much more foreign actors that come to your countries and participate in the debt market, and they hold local debt. So
yeah. Mustapha, do you have any thoughts on that?
I mean, I think there is certainly the case in many countries, as you say, but listen, but in other countries it's exactly the opposite. I mean, take Lebanon. Lebanon has collapsed. Okay, why? Because the foreign capital is coming into deposits in the banks in dollars. They're holding their deposits in dollars in the banks in Lebanon, and therefore, when the exchange depreciates, what happens? It's the banks go bust, and the government goes bust as well. And the central bank goes bust as in fact, because the central bank is borrowing in dollars and then lending the money to the government in pounds, in Lebanese pounds. So depends on the exact. Even though Lebanon is an open capital flow country, but the way it has worked out, the system it has worked out is that the investors don't come to buy Lebanese government debt in Lebanese pounds, but they come to deposit the money in the banks in dollars, and therefore the risk is taken by the government and the central bank as a whole. So it depends on the institutional and the exact economic setup which is taking place in the country.
Yeah, but in the case of Lebanon, as I understand, they have a very rigid exchange rate system before the crisis, and so for me, I kind of exaggerate, but I think that is key whether your exchange rate system allows the currency to float and to adjust.
Yes,
most what I have seen of my life in countries with problems is that the problem capital inflow outflows happens because they defend currencies. So market anticipate. So I think that's
this is true. I mean, Lebanon, they have been fixing the exchange rate since 1990, and even before 90, even during the Civil War, and it has been stuck, and therefore they are building the bets against the currency for more than 30 years. So that's exactly right. Exactly right.
So I have a couple of follow-up questions on this. Just want to again remind the audience to type in your questions. But the conversation that we've had up until now seems to almost assume the quote-unquote, I should say, and it might be a little bit provocative, the old order. We've seen now, geopolitical issues, fragmentations in the global economy, new alignments among certain emerging markets. How do you calibrate the vulnerability of emerging markets with these new potential alignments, vis-a-vis, matured, advanced economies? And I'm posing that to both of you. So, for example, you take India and, the relationship that India has with Russia, and how are we calibrating that with their markets and with the flows with the US, for example, just to take the two extremes.
The question is interesting because basically you say we live in a world always, but in a world with a lot of geopolitical tensions and political tensions. We just saw the war Ukraine and Russia. So we have a conflict political. How much they affect the economy, and how this can spread through the rest of the economy. We had one which has been quite costly for the world economy, which was Russia and Ukraine, because of the problems in the supply of gas, oil, and all that happened with commodities. Now, so I'm just, your questions, I haven't thought much before, but there are two types of geopolitical conflict or internal political conflict. Those that can derail the economy and those that are just turmoil. Many people many times mention an interesting case that's Peru. Peru, the economy has a track and they have political crisis after political crisis. They're a democracy.
Every other day.
And they change all the plus 5 former presidents, I don't know, or are in jail, or one suicide. So it's and the country works and business and growth is a one of the low income among emerging markets, but that hasn't been able to contaminate. But there are other places in which the contamination is much bigger. So, and I don't think that is a general thing. And yeah, of course, when a country reaching natural resources like Ukraine and Russia in the world, that's affect the world. The world.
Right.
Just, I mean, this is a very difficult question you're asking, but let me just, say a few thoughts. I mean, first, I think when we step back and we look at, and as Jose said earlier, when you look at the last 15 years, the two biggest economic crises came from the US, right? The first one and this one, they started in the US. And this is important because this means that any emerging market sitting out there and trying to figure out their future, they see, okay, if the shocks are going to be coming that way, I better protect myself from that wave, right? And therefore, I try to position myself in geopolitical order in a way that protects me better, in a better way. And therefore, this plays out in terms of diversifying, if you like, your economic and financial links and as much as you can. And that's why you are seeing this talk as of now of, diversification, the BRICS and what they want to do and, going, leaving and alternatives to the US dollar and what have you. And all of this debate is really coming from that, that, that risk. And the US, in addition, the US trying to use in a very sometimes awkward ways its power in a way which is not very, when you try to, to control SWIFT and not allow transactions to go through SWIFT because of your own rules and you impose them on everybody else is going to try to find another option, another solution, right? So from a geopolitical point of view, there is going to be this movements toward diversification of risk and in the economic and financial order, which is going to be playing out for a long time. I think the next 2 decades are going to be, about this, essentially about this diversification and, being less subject to dominance of the US financial rules, if you like.
So that's a very interesting point because essentially we're almost going back to the future with the concept of non-alignment that we've seen way back then, pre-1989, if you will, before the collapse of the Soviet Union. But if indeed there is this diversification, the question then becomes, how will that impact capital flows? And I'm thinking more, any portfolio as well as the FDI, or that at the end of the day, it doesn't matter because it's a question of yield and it's a question of commodities that you need to get, for growth, right?
Well, I mean, certainly it's going to be impacting the composition. Whether the global flows will be impacted, that remains to be seen. But there is certainly an impact on composition and directions of flows. I mean, there is no doubt about it. I think you're going to be seeing that happening in the future. Well, as to the global, I think there's no doubt that, whether you like it or not, globalization where is in a standstill or not, I mean, the increase in flows is going to be continuing over time in the future. There's no doubt about it globally.
Yeah, and I'd like to pivot to another question, but before that, from the audience, there is a question with regard to Turkey. It stands out for having resisted classical anti-inflation policies, with the result that inflation is, we don't even talk inflation, we're talking, kind of like hyperinflation almost, and the collapse of the lira. What will be the consequences of this to the neighbors in, the Mediterranean area?
Well, I don't think, Turkey is a big country, obviously, and has a significant impact. But there is no spillover directly for Turkey, because Turkey is operating in dollars essentially, because this currency is downgraded so much that it's operating in dollars in a way. But what's happening in Turkey has been happening in Egypt, even though it has not. It has followed similar, not the same populist as in Turkey, because Turkey, they maintain the interest rates low on purpose. The interest rate has to stay low. It has to be less than 10%, has to be 8% or 9% when inflation is 80%. Okay, so you expect what you expect, right? So now in Egypt, you observe the same phenomenon: the collapse of the exchange rate, the surge of inflation, and the surge in domestic debt as well, because the money creation and borrowing from the central bank and all of that, which is happening in Turkey as well. So the fundamentals are the same in Egypt as in Turkey. Now, I think I don't see that the impact is what happens to Turkey itself, because it will have an impact on the region, obviously, because if Turkey collapses, this has an impact, of course, because Turkey has become a very big economic power in the region as well, well beyond the Mediterranean. So whether it's in Africa or in elsewhere, so it's a big investor, and it's a big trader, and so on. So there is no doubt there is going to be a big impact. I mean, if Turkey collapses, and I don't know how Turkey is going to be getting out of its current mess. I mean, because the policies that are being pursued are ideological. They're not economic policies. They're not really economic policies. They're in the realm of the ideology that is being pursued, and so on. So.
Yeah, but to the point that you made earlier in terms of diversification, ideology could become a factor that is much bigger than before, when liberalism was really the key element, if you will.
Well, this one is not about the liberalism and not liberalism.
No, it isn't.
It's I don't know. No, it's another point which has been making the other day. I was at the conference. I was making this point. These days, I don't know. It seems to me that as our knowledge improves about economics and so on, decision making is less and less rational. And the US is a good example, but it's not the only example. I mean, how can you figure out the rationality of some of the policies being pursued by some of the leaders, and except that it's the populist attitudes and the rejection of rational discourse and rational arguments, and following just ideological ideas or preconcept of prejudiced ideas and so on. And we are seeing that all over the place. It's becoming dominant. Becoming dominant all over the place.
Time is running out here, but I'd like to, before we end, I'd like to just touch on another major issue, and that is climate change. And not just because in New York, where I am, we just got the whiff of unfortunately these fires in Canada, but climate finance investment has been funded or is funded by government institution. How should we think about the additional debt burden that, you know, to get as close as we can to the net zero by 2050. Because if you're falling behind, as any country, whether we're talking advanced or particularly emerging market, climate-related capital finance heightens the vulnerability of these countries. Jose, how would you?
I think that's an issue that many countries, emerging markets, have today. The world needs to prevent climate change. We need to do a lot of investment. We need decarbonization. So we need to invest. And who finance that investment? Already we were talking about countries that are very high in debt. And they said now, on addition, the world asked me to take debt in order to finance climate change. Now, there are two issues regarding that. The first one is that if that's necessary, perhaps the world should facilitate this indebtedness in some form. Because country cannot. This is like if I am extremely, let's assume I am an extremely poor country, but I have some essential things for climate change. But the first priority is to feed my people. So there is a trade-off that's very complicated. Or I do things for the world or for my people. Mm-hmm. And so there is an issue of finance. But the second thing that I think quite important is how we have to mobilize private sector resources for climate change. So in Chile, we have a green hydrogen, there's a lot of lithium. So we have to put that, and copper, that's very important for decarbonization. So what we have to, it's not the government that has to do the investment, it's the private sector. So there are many things that can be done by the private sector. There are others that necessarily will have to do, especially in terms of public goods and provision of utilities. So there is a lot. So, but I think that there is a tension in these highly indebted countries that at the end you say, okay, now borrow even more and do things to avoid climate change. So I would say in a world with things go well, just pay me for doing it, because this is a benefit for the whole world.
But this issue, I mean, as you know, this is at the core of the debate in the climate change of COP conferences and so on. I mean, and there is a moral issue here, really, more than any economic issues. It's a moral issue. I mean, who has to pay for this cost? I mean, because the burden, I mean, climate change has not been caused by the countries which are supposed to invest, right? Because it has been caused by those who have emitted for 200 years and have, contributed to the stock of CO2. And therefore, now you come to me as an emerging and poor guy and ask me, okay, well, you need to invest to mitigate and to contribute to the low carbon economy and so on. And I have to invest, 2% of GDP or 3% per year. And so who should pay? And this at the core of the debate, and this is not going to be solved by the market mechanism. I think it's going to be solved by politics. It's through the political arena at the global level and at the global discussions and debates.
So we are essentially faced with enormous challenges, given the fact that global growth is at a, okay, but slow. And we need to deal with rising debt. And before we get totally depressed, I probably will have to thank both of you because we're running out of time. So again, thank you so very much for taking the time to discuss these very interesting and important issues. And just one item for our audience is that there is a replay of this on the GIC website, and that's on the interdependence.org that you can see it. And you have there the website for also becoming a member. The next event that we have is on July 12th, and that's the GIC Teton Economic Outlook out west. So between now and then, I want to thank you all for dialing in, and particularly Jose and Mustapha, thank you very, very much for your thoughts.
Thank you.
Thanks very much to you.
Thank you. Bye.
Pleasure to be here.